And all right, welcome back, everyone who has downloaded this online. This is part 12 of Fundamentals of Income Tax, and we're going to be talking about the second part of Chapter 10 in the textbook. For those of you who might not have listened to one of these before, my name is Brian Clark, and I am your instructor. All right, for the evening. All right, so welcome back, everyone. Here we've just had a good weekend. The sun came out, nice sunny day after 3 days of really heavy rain here, so which is typical, what can say. But I hope everyone, wherever you are, had a decent weekend and is doing all right and enjoying some of the autumn colors. As always, if you have trouble, and this happened in yesterday's class, so if you are thrown out of the room, your computer has an issue, and you need to exit and come back in, these steps are helpful if you find that you can't hear us, what's going on. When you first come in, of course, put on the green check mark, and when you come back in, the steps here are important, particularly the last one, to click yes when WebEx does the little pop-up window. What we have found is that WebEx will sometimes spawn a window underneath the window. Yesterday there was a case where WebEx opened twice and you could only see the second one, and so when you're trying to sign in, it would say you're already signed in this one. So that was giving some confusion. So do remember, if you're having some persistent sound issues, particularly after locking back in, it may be an issue with Windows, or your browser might have another window open which is playing something or something like that. Main thing is, don't panic and just think it through. All right, as always, questions are very welcome as we go through the material. Chapter 10 is a very long chapter, and a lot of the topics in it have a lot of fine detail, so questions are perfectly fine. And indeed, questions are what make the course interactive and interesting, everyone bringing their own experience and their own perspective. And, there is simply more material in the textbook than we can cover even in a class and a half. So by all means, if anything is unclear, please ask, because if you have a question, probably someone else, maybe someone who is listening online, has a question that you could help me address. All right, so just to review, last class we introduced the topic of health, which can affect the tax return in numerous ways. And we talked about the concept of infirmity and how that is different from disability. And we talked about the credit known as the Canada Caregiver Amount, which is for infirm dependents. And we also talked about the disability tax credit, the situations in which it can be claimed. And then we just lightly began the topic of medical expenses with some of the basics. We will be going more into that and some of the more unusual types of medical expenses tonight. And if time allows, we can go online to the CRA website and see where they have some of the medical expenses listed. If we do run out of time, of course, just bear in mind, you can look up medical expenses on the CRA, and there is a lot of, many of them are specifically listed in a lot of detail. All right. That said, any questions? Anyone at this point? Oh, Valerie, did you have a question? Oh, that's okay. That's okay. All right. Perfectly fine. Okay, and we will have time at end of class for questions as well. All right. So first, we're going to review some of the material from last class, just to make sure it's still fresh in your mind. It has been a few days for us, so it'll be good to see how well you guys remember. Then we will continue talking about medical expenses. Then we are going to talk about the home accessibility tax credit, which is an interesting credit which has a lot of overlap with medical expenses, as you'll see. We will also talk about a similar federal tax credit called the multi-generational home tax credit and the British Columbia provincial home accessibility tax credit if time allows. If we don't have time to get into the provincial one, we will do so in Chapter 14, which is dedicated to advanced provincial topics. We're also going to talk about a deduction known as the disability supports deduction and when it can be claimed and how it interacts with the various other medical credits. We're going to talk about a refundable tax credit called the Refundable Medical Expenses Supplement, which a lot of people forget about because the parameters for qualifying for it are a little bit narrow, so it's easy to forget that it's there. And then we're going to talk about the interaction between the disability amount and fees for nursing homes or attendant care. So as you can see, tonight we're kind of digging into the more detailed topics within the broad topic of taxpayers and health. So, but before we get into the new stuff, let's have a bit of a review from last time to see how well people remember things. All right, so first let's look at this scenario. Vic and Rachel are married. Vic has a net income of $14,000 and Rachel has a net income of $44,000. Combined, they have $2,000 of eligible medical expenses. So, true or false? Vic should claim the medical expenses as he has the lower net income. All right, this isn't a poll question. Just put in the chat, what do you think? True or false? Or any other answer you would like to put in, but basically, true or false? Is this right or wrong? All right, I can see that some of you got the correct answer, and the correct answer is false. And Valerie, you've put your finger on the issue here. Vic's income is too low to need this tax credit. So his net income is $14,000, and that is less than the basic personal amount, right? Remember, the basic personal amount already will cancel out tax on the first $15,705 of income, and Vic has less than that. So claiming additional non-refundable tax credits will not benefit him. So the medical expenses should go to Rachel. Now, a couple points to stress then here. Either taxpayer can claim. Unlike some credits, it does not have to be claimed by the lower income taxpayer. It's just that usually the lower income taxpayer will be able to claim more of the medical expenses. However, you have to look at the whole thing and say, which taxpayer, for whom will it be more beneficial? And in this case, it would be more beneficial for Rachel. So for Rachel, the key point is her net income is low enough that the expenses, she'll be able to claim some of them. Now, does anyone remember the rule? Can you tell me the rule for how we calculate how much someone can claim for medical expense? 3%. Good, Grant. So can you give everyone a little more? Some of the people who have downloaded this later might not understand what you mean. 3% of what? Oh, good, Joy. Yes. Yes. So we deduct 3% of the net income. Right? So what is 3% of Rachel's net income then? So 3% of 44,000. So remember, we can approximate this, right? 3% of every 10,000 is $300. So on 40,000, that'll be 1,200. The maximum is $27.95, Valerie. That's right. So it doesn't matter how high your income is. if the medical expenses are more than 2,795. In this case, they are less than 2,795, so we need to deduct 3% of the net income only, which is exactly, Michaela, 1,320. So we take the 2,000 minus 1,320. Exactly, Humaira. 680 is what she can claim as a tax credit. Good. So you can see uh, you have to kind of look at both things. Normally, the person with the lower income, because their income is lower, they'll be able to claim more of the medical expenses. But if their income is so low they don't have to pay anything anyway, then there's no benefit to them claiming the medical expenses. But do notice that the couple has complete discretion over who claims. They could even split up the medical expenses. So things can happen, but yeah, so you need to always keep an eye on the whole situation. All right. uh, so Mohammed, it's not 2,759. Oh, hang on. Yes, what is it? Let's remember it's taken from the T1. If you, uh, it's right there in the T1. No, I didn't mean to click that. Here we are. And remember, you can always find a T1 in your fillable forms guide. For British Columbia, of course, is the 5010R. And if you look at the section for medical expenses, right down here, you can find it right down here, the calculation, and the maximum here, yes, 2759. Now this amount is, not 95. I got that turned around. Yeah, so 2759. This amount is indexed for inflation, so it's going to be slightly different every year, and the trend is upward, of course. But it does mean that if your income is the basic principle, though, is sound. If your income is high enough, then if the medical expenses are high enough, it doesn't matter how much income you have, you're always going to be able to claim some of them. But this is why we always combine all the expenses from the family and get one person to claim them, because that's normally most beneficial. All right. Yeah, so good catch, Mohammed. All right, let's look at the next one. So Isra and Aisha are common law partners, and Isra has a net income of 54,000, and Aisha has a net income of 104,000, and combined they have $2,000 of eligible medical expenses. So, true or false? Aisha should claim the medical expenses as she has the higher net income. All right, what do you think, folks? Pardon me, folks, I'm just making a note on my notes because I've discovered a typo in the speaker notes, although it's fairly innocuous. I'm just making a note to myself so that I can fix it for next year. All right, so here again the answer is false. So if Aisha were to try to claim the medical expenses, right? So remember, Aisha's net income is 104,000, and 3% of the net income. Remember, 100,000, 3% of that would be 3,000, and then so 3,000 plus a little bit. That's already over the maximum, right? So the equation works out as medical expenses minus the maximum of 2759, right? And that would be a negative number, so that comes out as 0, right? So the medical expenses are only $2,000. So in this case, Aisha, if she claimed them, they would be reduced to 0, so she couldn't claim anything. So for Isra, then, what would 3% of 54,000 be? 1,620. Okay, that's right. Good. So we would take exactly. So we would exactly, Humaira. Exactly, guys. Yeah, 1,620 is the 3%. So we 2,000 minus 1,620 leaves 380. Good job, everyone. All right, everyone feeling pretty good with that one? One more example. One more example. Okay, so Tanya and Rob are married. Tanya has a net income of 34,000. Rob has a net income of 47,000, and combined they have $1,200 of eligible expenses. So, who should claim the medical expenses, and what is the claim going to be? All right, good, guys. I think most of you have got it. So, sorry, I should have clicked that earlier. All right, but you're getting it. So, the answer here is Tanya. So the medical expenses here are only $1,200. So we have to subtract 3% of 34,000, and that leaves $180, right? For Rob, it would be 1,200 minus 3% of $47,000, which would be more than $1,200. So Rob's income is too high. Basically, it would be reduced to nothing again. So those are the things to watch for. Now, I think you can see that there will be situations where both partners, their incomes are quite close, and both of them could conceivably claim something. We've been giving you pretty simple, straightforward examples here. But, for example, if Tanya, in this case, had 33,000 and Rob had maybe 35,000, then it's much closer, and you could see a situation, for example, where there might be other credits at play, so you might put it to the non-optimal partner. One important point. I'm tripping over my tongue. I think it's some odd effect of being sick. I think it's just my mouth is very sensitive, so if I'm a little tongue-tied tonight, just bear with me. So one thing to be aware of, and we've seen this a little bit before, and we will see it again in the course. There is a priority order in which tax credits have to be applied, and medical expenses come in relatively late. So you might have to use some other credit before you can get to the medical expenses. So, for example, if Tanya or Rob had a lot of tuition credits, they would have to claim those before they could claim the medical expenses. So in cases like that would be a case where you might have to give the medical expenses to the partner with the higher income because the partner with the lower income, even though they had to pay tax, they had to use other credits first. All right. This is really going to become important when we talk about tuition in Chapter 13, but it does pop up now and again in other places as well. All right. Now, let's uh, have an example with the disability tax certificate. So for this one, we want to figure out what this person's tax credits are going to be from the limited information we have here. And again, we want to compare the non-refundable tax credits with their taxable income. So box 14 would be 50,000, and then their box 16 would be 2766.75, and then box 18 would be $830. All right, so take a moment to make this calculation. I'll jump in a minute and uh, help you out a bit, but let's see if you can figure it out. The key thing is the question here is how much of their income would not, of their taxable income, would not be subject to federal tax. So that's the same thing as asking how much do they have in non-refundable tax credits. The answer's a little low, Michaela. These aren't deductions, Grant. You're not deducting them from 50,000. We want to figure out the non-refundable tax credits. And we're not looking at the deductions here because, of course, there might be other deductions we don't know. That answer's also a little low. Well, you guys are in the right ballpark. Let me help you out a little bit. So the non-refundable tax credits here are going to equal the basic personal amount plus CPP, the base contribution, plus, that one's a little high, Valerie, plus EI, that's quite high, Mohammed. Okay, let me show you what it would be in this case. There are basically 5 numbers you need to figure out. So the non-refundable tax credits here are going to be the basic personal amount plus the CPP base contributions on line 308 plus the EI premiums on line 312 plus the Canada that should be CEA, the Canada employment amount, typo there, but so the Canada employment amount plus the disability tax credit. And if you miss one of those, then your number is going to be off. Now, some of these are straightforward, but CPP, we need to figure out. So remember with the CPP, what we need to figure out is the box 16 amount. Some of that is the deduction, and some of that is going to be claimed on line 308. So for the CPP, we can figure that out. Oh, yeah, you're getting it. You're getting it. I'll just spell out the CPP for anyone's still having trouble. So for the CPP, to figure out the box 16 amount, there's kind of 2 ways you can do it. You can either take the box 16 and then multiply that by the base percentage divided by the full percentage. Or you can do it with the numbers itself. So you can take the 50,000, the box 14, which we can assume is the pensionable income, and then we would deduct 3,500 to get the amount which is subject to CPP. So that would be 46,500, which is subject to CPP. So we would know from that 46,500, 1% of that is 465. Right? So to figure out the line 308, then we just take the box 16 amount, so the 2766.75, we deduct the 465, and that would give us 2301.75. Okay, so that's the tricky one. So guys, try again now. So you want the basic personal amount plus 23. So, sorry, Grant, I'm not quite understanding your question. Um, no, the enhanced portion is the 465. So that is the deduction. The base CPP contribution is the 2301.75, which is a credit. So to calculate the non-refundable tax credits total, then, right, we take our basic personal amount, 15,705, plus 2301.75, plus the box 18, 830, plus the Canada employment amount. And how much is that, everybody? Good, Mohammed, you got it. 1,433. Right? And how much is the disability tax credit? 98.72. So 15,705 plus 2301.75 plus 830 plus 1433 plus 98.72. How much does that give us? And yes, some of you have got this correct already, but for everybody else, exactly 30,141.75. That's his personal tax credits. That's his non-refundable tax credits. That is going to be compared to his taxable income, right? The tax on the taxable income. But another way of saying non-refundable tax credits is this is going the first 30,141.75 of your income is not going to be taxed, or the tax is going to be canceled out on the first 30,141.75. And I find that's a pretty clear way to explain it to clients when I'm walking them through the tax return, because otherwise, tax credits, it might be a little unclear what it means to them. But if you can say, oh, this cancels out the tax on this amount of income, that most people understand that. Okay, any questions, anyone? It's a little tough to do it without the form in front of you. I do know. I understand that. But any questions? Are you all clear how we got there? Excellent. Okay. Yeah. So now obviously software is going to do most of this most of the time, but it is important to understand how the software gets its numbers, so you can see if something's gone wrong somewhere. The trickiest part is the box 16, and understanding uh, how that amount is split apart into the deduction, which is 1% of the pensionable income after the $3,500 exemption is applied, and the base amount, which goes on line 30800. All right, let's talk about some medical expenses. Now, general rules for medical expenses, we touched on this last time. Medical expenses kind of fall in two categories if they are claimable. The first one is kind of for equipment and treatments. Certain equipment and treatments can always be claimed as a medical expense. So, for example, things like wheelchairs, prescription drugs, dental treatment, prescription eyewear, those can always be claimed as a medical expense. Some things can never be claimed as a medical expense. For example, over-the-counter medication, Band-Aids, uh, swimming lessons, even with a doctor's recommendation, cosmetic surgery, for example. So some things can always be claimed and some things can never be claimed. Some things can be claimed, however, if the person is disabled or infirm and or has a doctor's certification that they need the treatment. So, and that's what applies here. Vitamins, supplements, those are good examples of things which can never be claimed. There is also a category for if the medical expense is a service provided by a qualified medical practitioner. So this covers a lot of things like vaccinations and tests, medical documentation fees. So if your doctor charges you $200 to fill out the T2201, that would be an example of that. And that can vary by province as to whether a specific medical practitioner's services qualify as a medical expense, and that can be checked on the CRA website. So, and Mohammed has a question. I'll just pull it out here so I can see it. Is a lab test which is not covered under MSP claimable or not? Oh, that's a good question. It's important to understand that the criteria here have some similarities with, but are completely independent of whether or not something can be claimed for insurance purposes. So, for example, provincial healthcare like MSP, you can think of it like this way. If you go to Seattle and break your leg and have to stay in a hospital there, those expenses will not be covered by MSP, but they are still medical expenses which you can claim. So providing the lab test is done either by a clinic or a recognized medical professional. Normally it would be claimable. If you go to a naturopath or sometimes there's situations where you have to use judgment. So if you go to a naturopath and they do services for you, that is claimable. But if they just sell you a bunch of vitamins and supplements, those are not claimable, right? Lab tests generally are claimable if they are done in a clinic or similar setting. Similarly, vaccinations, normally claimable. And again, remember, for any specific one where you're not sure whether it is covered, you can look it up on the CRA website for either the practitioner or the medical expense itself. This can be tricky sometimes because you have to figure out, how would this be described on the website? And if time allows, later in the class, we'll have a look at the list online just to give you an idea of how it's all laid out. Now, attendant care is one of those things where it will be qualified as a medical expense, but only under certain circumstances. So, it is a medical expense if the taxpayer qualifies for the disability amount, in which case, obviously there's no question why the person needs attendant care, or if the attendant care is at a self-contained domestic establishment, that normally meaning the taxpayer's home, the disabled individual's home. In that case, it needs to be because the taxpayer is dependent on others due to a mental or physical infirmity. So, for example, if you don't have a disability certificate, but maybe you are laid up at home for 6 months with 2 broken legs or something, then attendant care would be claimable. Now, the phrase self-contained domestic establishment. Sorry, let me go back a step. When we're talking about attendant care, it's important to also understand. So, apart from what we've mentioned here, that the person either needs to have a disability certificate or be dependent on others and in a self-contained domestic establishment. It's also necessary to clarify what we mean by attendant care. This is attendant care for more medical purposes. So not uh, things like maid services, meals on wheels, handy transit, hairdressing, things like that. It's more an attendant to assist the person with necessities of life. So if you are injured, stuck at home, can't leave the house, and you order a pizza to your house, that is not attendant care. But someone who comes to your house, stays with you all afternoon, does things for you, uh, uh, provides treatment, checks your blood pressure. That's what we are talking about here. Now, self-contained domestic establishment, that is very specific wording, and it is defined in the Income Tax Act. What it basically means here is it draws the line between a taxpayer's home and a situation which wouldn't qualify. So a home could be something like a dwelling house, an apartment, or a similar place of residence in which a person, as a general rule, sleeps and eats. The size of the dwelling, the size of the establishment is of no consequence. So even a one-room bachelor apartment could qualify. The key thing is it needs to be self-contained. So some sort of living unit with restricted access that contains a kitchen, a bathroom, and sleeping facilities. So typically a room or rooms in a hotel or a boarding house would not ordinarily be considered a self-contained domestic establishment. Now, Mohammed's asking about MSP. If something happens out of province, will MSP cover those expenses? Um, Generally, if you are out of province, you would want travel medical expenses for that. Um, it's not exactly clear to me how it is handled within Canada for different provincial healthcare systems. I would need to check that. That's kind of beyond the scope of this course. It's not really an income tax question. MSP is for anyone listening to this who's downloaded it and is not from British Columbia. This is, of course, the British Columbia uh, recording. MSP is the British Columbia Provincial Medical Services Plan, and there was a monthly premium charged for it until about 7 or 8 years ago. So since then, it's kind of faded out of relevancy for income tax purposes. Although people can still go back and apply for a refund of those premiums by providing the government with their income tax information for those years to prove that their net income was below a certain level. So that said, about MSP, I think in general, when you go from province to province, you need to double check what the rules are. They may not be consistent from province to province, and I don't know off the top of my head if there's some kind of interprovincial compact to make sure that services will be provided. But certainly, if you go out of country, they would not be covered. It is important, though, for anyone who missed it, in case we didn't get into it last time, just to be clear, if a medical expense is claimable if it takes place in British Columbia, it will also be claimable if the taxpayer from British Columbia gets the expense done elsewhere. So in another country or another province, it is claimable. If it is a medical professional service which is recognized in that jurisdiction, then it can be claimed as well. All right. Which is to say, if the medical professional is not recognized for tax purposes in British Columbia, but it is recognized in the other province, then that would be covered. All right. Now, speaking of traveling, there is a time when we can claim travel for medical purposes as a medical expense. Now, this happens generally if you cannot receive medical treatment locally. So this is typically then claimed by people in small towns or remote communities who have to travel a long distance to a bigger center to get treatment or specialized treatment. So even on Vancouver Island, for example, if you live in a place like Parksville and you need to get cancer treatment, you may have to travel all the way down to Victoria to get treatment, or up to Comox to get other treatment, because Parksville doesn't have a significant hospital in it. So the way medical travel expenses are calculated then, and there's uh, and of course, for all of this, there's more detail in the textbook. But basically, you can claim transportation costs if the distance is more than 40 kilometers to the place. And you can claim other travel expenses if the travel distance is more than 80 kilometers. So, if you had to travel from Parksville to Victoria, say, that's more than 80 kilometers. So you would be able to claim meals or lodging. The same rules for claiming expenses here can be used as are used for moving expenses. So you could use the simplified method, the per kilometer rate, and you can claim the simplified method for meals, and you would need detailed receipts for anything else like hotel stays or things like that. If the travel distance is under 80 kilometers but more than 40 kilometers, then you cannot claim meals, lodging, and other travel expenses, but you can still claim the basic things like mileage. Now, key thing is the equivalent medical services have to not be available locally. And if necessary, then it might be necessary to require a doctor's certification to agree that, yes, this person needed to travel. And they're not just driving 2.5 hours to a different hospital for fun. All right. Now, sometimes for people who are traveling very long distances, down from the Yukon, for example, or the far north, um, they may receive a travel grant from the government or a third party. But particularly if they're receiving it from the government, then the grant that's received has to be deducted from the claim. Right. So, all good. Any questions, guys? The main thing is that the taxpayer has to keep detailed records, which of course may not be the priority for people in this situation. But the best thing they can do is just keep a travel log. Normally, if you know the dates of the visit, you can just uh, reconstruct it. So even something as simple as writing on a calendar and saying, on this date we went there, and on this date we went there, and so on and so forth. Uh, Now this also would, I believe, cover international travel. I don't think there's a cap on it, um, but there might be some other restrictions. But it would be reasonably rare that you would need to travel outside Canada for medical treatment, which simply wasn't available in Canada. That's only going to be applicable in a very small number of cases in any case. All right, and Gurjinder asks, every taxpayer is eligible to claim medical expenses? Yes, it's only restricted because it's a non-refundable tax credit, so not everyone has enough income to benefit, and then it's restricted by the 3% of net income rule. If you're already outside Canada, well, I mean, then it depends, and you need medical assistance. Sure, if you are a Canadian resident for tax purposes, right? Now, in the case of part-year residents who enter Canada, immigrate to Canada, the question of when the service was incurred becomes important. But if you're a resident for Canadian tax purposes and you're outside of Canada, then those expenses would be claimable. It's the same, it's just like you're on a vacation, you're in Hawaii, you're in Thailand, something happens, you're going to a jungle somewhere and you have to get a snake removed from your arm. Those expenses you can claim, absolutely. Yeah. So yeah, it's if you're already there. you can claim the medical expenses, but if you're on vacation and something happens while you're on vacation, it's the travel expenses that you can't claim. Right. Now, similarly, there's a fairly detailed uh, set of rules around claiming medical expenses that relate to renovations or alterations to a dwelling. Now, we've kind of touched on some of these concepts a little bit before, but here we're going to dig in. Oh, sorry. Urja's got a question about the carry forward policy for medical expenses. I think we touched on this on the very end of last class. We can review it again. Remember, what I mentioned. It's you can claim medical expenses from a 12-month period, and you can slide the 12-month period backwards if necessary to capture more expenses to get a higher total. So it's not exactly a carry forward. It's more that your medical expenses can be claimed this year, and if you didn't claim them this year, they could potentially be combined with expenses for next year. But the total length of time covered is only 12 months. And Valerie, that's a good question. So yes, one way. So it's got to be significantly far. So 40 kilometers one way. And it's also supposed to be measured by the shortest publicly available route. So you can't take a back road in order to make the distance longer or anything like that. But normally it's pretty clear. The only headaches that sometimes pop up is if the hospital is right on the border of 40 kilometers or right on the border of 80 kilometers, something like that. All right. Now, for renovations or alterations to a dwelling, these can be claimed. First of all, they can be claimed as a medical expense if the taxpayer has a medical reason for it. So if the taxpayer lacks normal physical development or has a severe and prolonged mobility impairment. So not all disabilities would apply here. Someone who has a mental impairment, for example, there might not be any renovations which could be done to assist with that. It needs to be a disability or an impairment that affects someone's ability to move around. And the expenses have to be incurred to enable the taxpayer to gain access to or be mobile or functional within the dwelling. So these are things like grab bars in a shower, expanding a driveway in order to allow access to a bus or other modes of transportation, a wheelchair ramp, for example. The general rule is that the renovation expenses are not going to be allowed to be claimed if the renovation can be expected to increase the value of the home, and the expenses would typically be incurred by persons without such an impairment. So putting in a hot tub, that's not something that only a disabled person would want. Hardwood floors might be better for mobility, but again, that is an improvement which improves the value of the home. In other words, you can't sneak a bunch of renovations in to raise the value of the home and then say, oh, it's totally for medical purposes, right? There needs to be specific things that are targeted to assist with mobility. There's more examples in the InfDoc if you are curious. Now, an important thing about this is that the official receipts are required. So it needs to be a receipt from the contractor. It needs to be a clear listing of how much money is included. So how much was paid, GST numbers, and so on. And that, of course, can sometimes be an issue if the person doing the work is just working informally, isn't a registered contractor, or things like that. All right, now Urja asks if they put an elevator in the house, it would not be allowed. Um, I would say it depends on the type of elevator. As you are aware, of course, there are some elevators which are specifically for wheelchairs, which go on stairs, and there are elevators which are specifically for wheelchair use. That kind of elevator, I think, would be fine. If you were to just put in a general purpose elevator which anyone could use, that would be harder to claim, I would think. Um, like there might, yeah, I'm trying to think. Off the top of my head, I would be very skeptical that that could be claimed. Uh, but mostly what people get for uh, elevators within a house would be like a stairway elevator or that sort of thing, right? And that's kind of the logic we have to use. It's like look at this and say, okay, does this? What is the intention of this? I think that's why they put in the phrasing around, is this something that an average person would get? Because a regular elevator, a regular person with a lot of money might put in a house, but no one is going to put in a wheelchair elevator on a stairs, except very specifically to improve access to someone with a wheelchair. All right. Now, we will come back to home renovation expenses in a little bit, not to worry. But before we get back to them, but keep them in mind. We're not done talking about them yet. You can also claim moving as a medical expense in some circumstances. So, do you remember when we were talking about the home buyer's amount and the home buyer's plan? And we were talking about how those could be claimed if the reason for the move uh, was related to mobility. So just like we were discussing with home renovations for access, moving can be claimed as a medical expense if it is to a house or a home which has greater access. So moving can be claimed as a medical expense if the taxpayer lacks normal physical development or has a severe and prolonged mobility impairment. In other words, they have a disability or similar condition where they need to move to another house. So in this case, you can claim up to $2,000 of the moving expenses as medical expenses. So two important things to note here. First, the general rules for moving expenses apply as to what is and is not a moving expense. So the simplified method can be used, meals and lodging could be claimed, and for long moves, right? And otherwise, the same general rules. A lease cancellation payment, that's a moving expense. U-Haul, storage, claimable moving expenses. The key thing to understand here is that because these are not being claimed as a moving expense deduction, the rules for a moving expense deduction that we talked about previously do not apply here. So moving expenses claimed as a medical expense, the 40-kilometer rule doesn't apply. The need for a new job doesn't apply. The purpose of the move requirement is only, is this for medical reasons? But we have to keep in mind that if you're claiming the expenses as a medical expense, you are limited to the $2,000. So if you had a case where a move could qualify as a moving expense and a medical expense, so for example, you're moving more than 40 kilometers for a new job and to a home which is more accessible and you're mobility impaired, then you would want to claim the expenses as a moving expense instead. All right, so we've been talking about the need for receipts, and in general, this is true of all medical expenses, that the CRA often checks wants to see receipts, wants to check your math, wants to see where the numbers come from. Because, of course, when we submit the taxes and send this number to the CRA, there's $2,000 in medical expenses, the CRA doesn't know what those are. So if you submit a tax return with very high medical expenses and you haven't done that before, the CRA will want to see some details about that. So medical expenses should not be claimed unless you have receipts to back them up. In general, you can think of it the same way you would as the receipts you need for an insurance claim. If you have ever had to claim reimbursement for insurance for services, each receipt needs to have your name, the date, the name of the service provided, and the provider on it. You can't just send in a summary of what you paid to the chiropractor for the entire year if it doesn't have more details, because then the insurance company will say, this doesn't have enough details. Please resubmit this. Similarly, with medical receipts, if you are sending in any kind of year-end summary or things like that, you need to be careful and just make extra sure that it has the required information that the CRA will be looking for. And again, some claims can only be claimed if someone has a letter from a medical practitioner and/or is disabled and/or infirm. So where you would again need a letter from a medical practitioner. Sometimes medical insurance premiums are paid through an employer or a pension plan, in which case those medical insurance premiums would show up on a T4 slip or a T4A slip. So we want to be aware of that and watch out for that. That can be complicated if you are claiming medical expenses for a 12-month period, which is not the calendar year. So in that case, you would need to double check and say, okay, you pay your medical insurance premiums. What day of the month are they paid? Were they the same last year as this year? If they are constant over the period and you're claiming a full 12-month period, then the amount you're claiming for the premiums is probably going to be the same as what would show up on a T4 or T4A, but you would need to exercise some caution there. Just to double check. Again, canceled checks, credit card receipts, in and of themselves are not acceptable as substitutes. The medical receipts in particular need to have all the required information on them. All right, so up till now we've been talking about medical expenses. There is a second credit for home accessibility expenses. Now this is introduced, first it was introduced in about 15 years ago. I forget the exact year. Oh, hang on. There's a question. Mohammed. BCRAHA. Sorry, which one is that? I don't recognize that acronym. Is that a rehabilitation? In general, I'm unfamiliar with them, but in general, the rule is anything that was not paid by the taxpayer cannot be claimed as, you cannot claim that portion as a medical expense. So if you are getting dental work at the dentist and your insurance covers $300 of your $400 treatment, then you can only claim $100 as a medical expense. So and many medical expenses are paid for by third parties or even free of charge. So there's nothing to claim there. So if this Rehabilitation Association is paying for the treatment entirely, then there's nothing to claim. Or if it's a case where they pay 60% of something, then you would claim the portion that wasn't covered. That I think would be the general rule to look at. The only exception might be in some case where some charitable organization gives someone a grant for the entire year and there is no requirement that they spend it on medical expenses. Then it's more akin to income or social assistance, and wouldn't need to be considered in this way. All right, so medical expenses then, that's one credit. But there is a second credit, and it was introduced first about 15 years ago as a stimulus measure, and it was called the Home Renovation Tax Credit, and it was calculated on Schedule 12. Then it went away for several years, and then it was brought back in 2016, and was used to calculate home accessibility expenses on the Schedule 12. So it was initially brought in. So as I said, it was a stimulus measure designed to encourage people to renovate their homes, either for disabled individuals who would meet the criteria we mentioned previously, some sort of mobility impairment or lacking normal physical development, or for seniors who wanted to improve the accessibility to their home. So it's important to understand this is an entirely separate credit from what we were just discussing. So if the home accessibility expenses are for a disabled person, they will qualify as a medical expense, and they will qualify for this credit, and you can claim both credits. If they are only for a senior person who is not disabled and doesn't meet the other criteria, then they cannot be claimed as a medical expense, but they will still be claimed as a home accessibility expense. So the way it works, it's a maximum claim of $10,000 from 2016 to 2021, and since 2022, that's been raised to $20,000. So the amount of home renovation expenses you have for home accessibility purposes is calculated on the federal worksheet. It used to be on the Schedule 12. It has since been moved to the federal worksheet, and the Schedule 12 was temporarily retired, and then it was brought back, but we'll get there. So currently, home accessibility expenses are calculated on the federal worksheet, and then they are entered on line 31285 in Part B of Step 5. Now, the Inc. doc has detailed definitions of what constitutes qualifying renovations and an eligible dwelling. These are very similar to the qualifications for renovations or alterations of a dwelling that are done for medical expenses. Technically, the two lists are distinct, so if you had an edge case, you would want to have a look at it just to be sure. But in general, the eligible dwelling part of it here needs to be a home that the qualified individual, who is a senior or a disabled individual, occupies, so owned by themselves or by a supporting relative who is claiming the credit. Here, the supporting documents are still going to be required: agreements, invoices, receipts, so on. And we're going to show you the federal worksheet in a couple of slides. Again, the key point, though, is that this credit is claimed in addition to medical expenses in cases where it can be claimed under both, which is unusual for tax. So on the federal worksheet, the following information is needed. So you need the date of the purchase, if you're purchasing supplies or lumber, say, or the contract, and then the supplier's name and the GST, HST registration, a description of the item or service, and the amount paid. This does apply to renovations that you carry out yourself, in which case, you would list the supplies you do, and if you're doing the work yourself, you're not paying any labor costs and so on. But it can also be situations like with a contractor who comes in and does the work. The worksheet itself is fairly straightforward. So you have the date on the left, you list the supplier and the GST number if applicable, a description of the goods or services, and then the amount paid, including taxes. That gives you your eligible expenses, and you can claim those up to a maximum of $20,000. Now notice, because the way things are worded, this amount can be split between other qualifying individuals or eligible individuals who are living in the eligible dwelling. So obviously, more than one person can be living in the home, so they can uh, split this credit accordingly. And there's no particular restriction on how it is 20,000. And then the amount being claimed is entered on line 31285 of your return. Illustration 10-11 in the textbook has more details there. If we have time, we can have a look at that later. As I say, in my last session, we ran short of time, so I want to make sure we have time to do the chapter review problem. So we will keep pushing along. Just check. Okay. Now, another thing to add, just because obviously some people might try to exploit this. In general, reasonable rebates or incentives do not have to reduce the expenses claimed. The CRA doesn't provide a precise definition of what reasonable is, but think of it this way. If a manufacturer has a rebate for a small percentage on purchases of goods and sent in by sending in the proof of purchase, that's probably reasonable. If somebody gets air miles for purchasing lumber, that's reasonable. But say if a contractor does $1,000 worth of work, but offers to issue a $20,000 receipt and a $19,000 rebate, this would not be considered reasonable by the CRA. They would probably consider it unreasonable, if not outright fraud. So that's the sort of thing which this provision is referring to. So again, if the expenses qualify both as a home accessibility expense and as medical expenses, you can claim both. And this would apply to situations of disability. This is a special exception to the general rule where you cannot claim the same dollar twice in doing taxes. It is entirely possible for expenses to qualify under one provision and not the other. And all we need to do is think of, seniors who are not disabled to understand why that might come up. But the definitions of expenses are still technically unique. It is possible an expense could qualify for one and not the other. Now, British Columbia and New Brunswick both have a corresponding provincial credit calculated on the provincial Schedule 12, which is based on the old federal Schedule 12. And the provinces that have this credit may have slightly different qualifying criteria. British Columbia's qualifying criteria are slightly different for this credit, and in British Columbia, this is a refundable tax credit instead of a non-refundable one. If time allows, we can have a look at it. We're probably not going to get time today, I suspect. If we have time at the end of the class, I will. Otherwise, we will do it when we get to Chapter 14. Right, so let's see how well you've absorbed all of that. So let's suppose a single taxpayer who's disabled and has a certificate on file with the CRA. Let's suppose they had a net taxable income of $40,000 and they have a receipt for prescriptions in the amount of $22,000, and they've paid for attendant care, paid $4,000 for that, and they've had a new ramp installed for a wheelchair for $5,000. So, what non-refundable tax credits relating to medical expenses can this taxpayer claim? There are three. What are the three tax credits this taxpayer is going to be able to claim? Good. But which one? Hmm. So the wheelchair installation, wheelchair ramp, so that would be the home accessibility tax credit for $5,000. What are we going to be claiming the prescription under? So that'd be a medical expense. So we're going to be claiming medical expenses on line 33200. So what is the total of the medical expenses? We take our medical expenses, remember, and we deduct 3% of the net income. Let's begin by the total for medical expenses. What qualifies as medical expenses? And how much is that total? The total is 11,000. Good, Mohammed. Right? So the 2,000 is added to the 4,000, added to the 5,000. So the raw medical expenses are 11,000, and then we deduct 3% of the net income. So what is 3% of 40,000? 1,200. Good. So we take 11,000, and we deduct 1,200, and that equals our credit of 9,800. Good. On line 33200. All right, and so we've got the home accessibility tax credit, and we've got the medical expenses tax credit. And what is the third tax credit that could be claimed? Good, the disability tax credit for 9,872. Good. We don't want to forget that because that also comes into play here. All right, good stuff, guys. Any questions about all of that? You feeling reasonably comfortable? All right, so what time is it here? Let's see. We'll have a couple questions and we'll take our break because we're coming up on the halfway point. So let's. I've been doing a lot of talking. Let's let you have a poll question and make sure I've got the right question here. We'll set this for 1 minute. Okay, so yeah, it should be easier. It will be easier with the form in front, but yeah. All right, so we're going to fill in the blank. So if you had to travel at least 40 kilometers blank from your home to get medical services, you may be able to claim the public transportations you paid, for example, taxi, bus, or train, as medical expenses. Where public transportation is not readily available, you may be able to claim vehicle expenses. So fill in the blank, A or B, one-way or return trip. And because you are a very on-the-ball class, I think you may have cottoned on to this earlier, but let's just see who was paying attention. All right, got about 30 seconds left. A few people haven't done it yet. I assume they are maybe getting a glass of water or something like that. But they still have 15 seconds to put in their answer. All right, good. So most of you got the correct answer, which is one way. One way. It's 40 kilometers one way from your home to get medical services. So, and again, so this is typically this is a credit for people in have to go from one town to another town, uh, either to the next biggest town or sometimes much farther, in order to claim the expenses. All right, and let's just so we're all comfortable. Let's see. Uh, Speaking of travel expenses, uh, if you can get these. So these medical expenses, they're an eligible medical expense, but some of them have a different minimum. So for each expense, is it a minimum of 40 kilometers or a minimum of 80 kilometers? So meal, is it a minimum 40 kilometers or 80 kilometers? Sorry, you should be able to see it now. Myra, sorry. Good. Meals, 80 kilometers. Excellent. All right. How about hotel and accommodations? Doesn't have to be overnight, yeah, but that would normally go with the distance. And again, it's 80 kilometers. Yep. Yeah, if it's just 40 kilometers, you're probably not going to need to be there overnight. And travel, good. So general travel expenses only have to be 40 kilometers, right? So your per kilometer rate, your bus tickets, whatever, however you travel, because it doesn't have to be by personal vehicle, but this really is aimed at needing to use a personal vehicle when you just can't get around through local transit. That's right. For British Columbia, 57.5 cents a kilometer. Exactly. Just the same as for moving expenses or other purposes. And how about parking? So if you're ever unsure of one of these, uh, you can check it in the textbook. For parking, it is 80 kilometers rather than 40, which seems a little unnecessarily restrictive to me, particularly given how expensive hospital parking tends to be. And I don't understand the particular. It doesn't. I don't understand the logic there. But for any given expense, though, you can always check in the textbook to see what it is. And sometimes the rules change from year to year, so it doesn't hurt to check. So if you're doing these expenses 3 or 4 years from now, check the rules and see if they've shifted. It's certainly not something I would agree with. I don't really understand how parking isn't a valid expense at 40 kilometers, but is at 80. But I am not the Minister of Finance. I'm not even anywhere in the line of succession for the Minister of Finance, so I cannot say. Well, no, travel, right, is just your basic per kilometer rate. Right? So that can be claimed at less than 80. I don't understand why parking. In other words, I don't understand why parking isn't considered a basic travel expense. All right, but that was a lot of heavy lifting, and it's close to 7:30. So we are going to take our break, and I think we'll take a full 15-minute break rather than taking two short ones because you guys you probably could use a break. So let's break until 7:45. And after the break, we are going to be looking at one is back. Let's put the polls down here and the chat up here. All right. So we've been talking about tax credits. Now let's talk about the disability supports deduction. Now, this is basically a deduction which is aimed at people with a disability who are working or going to school. So someone who is working or going to school but has a disability may have to incur certain expenses in order to do so. And if so, they can claim these as a deduction. So these would be expenses that are incurred to be employed or carry on a business or carry on research or do similar, usually postgraduate work, and for which you're getting some kind of grant or other income, or simply to go to school. So this can either be a designated institution, educational institution, that is a post-secondary school, or simply a secondary school. So this also applies to high school if you're enrolled in a educational program. Now, a couple things to note. Actually, I've got quite a few notes here. But so first of all, these expenses, we're talking things like note-taking services, braille readers, and so on. There's a quite specific list. We'll get more into that in a moment. But often these expenses could be claimed as a medical expense credit because almost all these are medical expenses, potentially. So in that case, you need to consider whether it's better to claim it as a disability supports deduction or a medical expense, assuming that there is eligibility to claim it as a disability support deduction. Unlike home accessibility expenses, you cannot double claim these expenses. So it's not possible to claim the same dollar simultaneously as a disability support deduction and as a medical expense. So in any given case, then you have to choose which one's going to be optimal. Normally the deduction will be better as it both decreases net and taxable income, saves tax at the top marginal rate, and might also increase other credits and social benefits, and it doesn't affect the claim for the disability amount. Usually then, if the taxpayer has enough income that the deduction is beneficial, it will likely be the optimal choice. In a case where a taxpayer is married or has a spouse and their income is relatively low, however, so that the spouse or common law partner is claiming the spouse or common law partner amount and supporting the taxpayer, then in cases like that, it may be, well, even there, it would probably sometimes be beneficial. All right. All right. There's also an additional rule which applies to all attendant care. I think we touched on it last time, but we'll hit on it a few more times. Attendant care has a limit of $10,000 if you are claiming the disability amount. So if we are claiming attendant care either as a disability supports deduction or as a medical expense, it is restricted to $10,000. Anything above that, and you cannot claim the disability amount. All right, so the disability supports deduction then. What are the nuts and bolts of it? It's a relatively simple form, the form T929, where we calculate it, and then the deduction is claimed on line 21500, and the list of qualifying expenses was expanded as of 2024, so we will look at that in a bit more detail as well. So on the form, in step 1, the disability supports expenses are entered, and in step 2, the disability supports deduction is calculated. And then the amount calculated on line 12 of the form is then transferred to line 21500 in step 3 of the tax return. So, step 1 then. As you can see, it's fairly straightforward. The expenses are listed on the left and in column 1, and this can be a device or a service. We will look at examples in a couple slides. Column 2, you have the amounts paid, and in column 3, if there was any reimbursement or assistance received with paying for something, so if a wheelchair was partially covered by a grant, for example, would be a common example, or say an employer is paying for some of the service, then whatever the taxpayer did not pay out of pocket cannot be claimed. So column 2 is totaled up, and then column 3 is deducted from column 2, and what is left over is the net disability supports expenses, which we'll pass on to the next step of the form. And notice, as usual, if you need more space, use a separate sheet of paper and attach it to this form. And again, that's a general rule in tax. If the physical form is too small, but you have more information to add to a list, almost always the number of lines on the form is not representative of any legal restriction, simply a reflection of that the physical form has to fit on the physical piece of paper. And of course, with tax software, these forms can have extra lines added to them very easily. But if you're restricted to the paper form, then you only have so many lines to enter things. So in step 2, first you calculate your earned income. So remember, the purpose of the deduction is to support you either going to school or earning an income. So your earned income is going to factor into it. And as we've seen in other similar credits, like moving, similar things that are claimed, like moving expenses, earned income needs to be calculated specifically for this purpose. And again, so this would be income from work or business, or for educational grants, which you're paying taxes on, so other income of that sort. And for people who aren't in school, that is the amount which is going to be the limit of what you can claim. If you are going to school, any income which is not earned income is entered up here. So your net income is up here, the earned income is deducted from it, and then whatever's left over, the non-earned income, line 7, is then compared to the number of weeks you were in school times $375. So $375 per week, in other words. And so you take either this other income here from line 7 or the $375 a week from each school, whichever is less, and then there's a maximum of $15,000, which can be added on here, right? So the incomes are added together here on line 10, and this total on line 11. So this total from line 11 is then compared to line 3 on the previous page, which is what was actually paid for the expenses, and whichever one is less is what is claimed on line 21500. Okay, so you either claim the total for the disability supports as the deduction, or if your income or equivalent allowance for weeks of school is less than what you paid in disability supports, then you just claim enough to cancel out the income in the weeks of school. And again, this is similar to what we've seen with other deductions and credits of this type, which are restricted by earned income. So after this is figured out, which number you're going to use is then entered on line 22215 of the tax return. And as you can see, right on the T1, it says that you need to complete Form T929 in order to do it. So fairly straightforward. The main thing is being aware that this deduction exists, and in situations where you could claim an expense as either a deduction or a medical expense, figuring out which one is going to be more beneficial to claim. Because, of course, some expenses could also be claimed as medical expenses. So you need to figure out what's most beneficial in any given case. And again, claiming the disability sports deduction does not affect claiming the disability tax credit, which is not true of everything we're going to talk about tonight, but this does not affect claiming the disability tax credit. In other words, you can claim both. Note, the deduction cannot be transferred. It has to be claimed by the disabled taxpayer themselves. It cannot be transferred to a spouse or other supporting person, and as usual, receipts are required. Now, again, the same dollar cannot be claimed twice when we're talking about expenses. And for this credit, the expenses which are claimable are quite strictly specified, but the list, I keep biting my tongue, it's very annoying, but the list has been expanded for 2024. So for example, the list now includes things like an ergonomic chair, a bed positioning device, a mobile computer cart, an alternative input device, so voice to text reader, something like that, a digital pen device, navigation devices for low vision, and costs related to service animals, so goods, services, and expenses. And again, the full list of expenses is in the textbook. Okay, so the next thing we're going to look at is not a medical expense, is not exactly related to health, but as you'll see, does kind of relate to the other things we've been talking about. So in 2023, the government introduced a new home renovation tax credit called the multi-generational home renovation tax credit. And so they brought back the Schedule 12 for this new credit. This has created a situation where the provincial Schedule 12s for British Columbia and New Brunswick are for renovations for home accessibility. This Schedule 12 is different. It is intended for situations where you are adding a secondary unit to a home for relatives that are seniors or disabled in order for the relatives to live with you. So it has this tenuous connection to the health issues we've been talking about previously, and it is similar to the home accessibility tax credit in that it's aimed at seniors or disabled people. But here it is very much restricted to the creation of a new secondary unit, so a basement suite or similar situation. These expenses, because creating an entirely new suite, secondary suite, can be very expensive. The credit is based on up to $50,000 of eligible expenses, and it's refundable and is calculated as 15% of the $50,000. The format, then, of a lot of language we're using with it is very similar to what we've been talking about for home accessibility expenses, but this will generally apply in different situations, so there won't be much overlap between the situations. To qualify for this tax credit, the qualifying individual needs to be 65 or older at the end of the renovation period tax year, or 18 to 64 years of age, but eligible for the disability tax credit at any time in the renovation period. The qualifying relation needs to be 18 or older, and a broad range of relatives can apply. So parent, grandparent, child, grandchild, brother, sister, aunt, uncle, niece, or nephew of the qualifying individual. Again, you can see it's quite similar to what we've been discussing previously. For the eligible individual, they have to be a resident of Canada for the full year in which they are making the claim and must reside or intend to reside in the same home as the qualifying individual or qualifying relation within 12 months of the end of the renovation period. Right? So this is the key. So this is not for people who are just coming to visit temporarily or things like that. It is a situation where you're all going to be in the same place and you need to create a secondary suite. Now, the eligible dwelling has to be located in Canada and has to be owned by the qualifying individual or the qualifying relation, jointly or singly, at any time during the renovation tax year, and it has to be ordinarily inhabited or reasonably expected to be by both the qualifying individual and the qualifying relation of the individual within 12 months after the end of the renovation period. Furthermore, it has to be a genuine secondary unit. So a genuine self-contained private unit. So it has to be has its own private entrance, kitchen, bathroom, and sleeping area. Again, similar to what we were discussing earlier with what constitutes a dwelling for attendant care purposes. It's the same sort of language. It needs to be a self-contained suite, and it has to either be newly constructed or created from an existing living space that did not already meet local requirements to be considered a secondary dwelling unit. So it has to be, say, converting a basement or something like that. You cannot just take the basement suite you have already and then say, aha, I'm going to get this credit now that grandma's coming in to live with me. It's like, no, you can't do that. And lastly, it has to be legal. It has to meet all applicable local requirements, permits, codes, and bylaws, and so forth. So it can't be an illegal suite. Obviously, the federal government is not going to encourage the construction of illegal suites that violate city bylaws in order to get tax credits. So that language, pretty much has to be in there. In some cities around the country, I know there's been a lot of controversy around the illegal suites and secondary suites. So often the local regulations around things can be a bit complex or muddy or murky. So if you are in a situation where someone is thinking of doing a secondary suite, then it's contingent on everyone involved just to look very closely at the legal requirements there. Right. And everybody doing okay? Seems to be. Right. So the Schedule 12, let me pull my windows down even more. So it's similar to what we've seen before, but a little more detail to it. So first, the annotations. Here we go. So up here, similar to what we've seen before, you add up the qualifying expenditures, the date of the sales slip or the contract, the name of the contractor or vendor, the GST, HST number if applicable, the description of the service or the goods, and then the amount paid, including taxes. Total that up for the qualifying expenditures. As we've seen previously, if there's any amount which is being paid by a third party, government assistance received, homeowners grants, that kind of thing. If that paid for part of this, then it has to be deducted. And then you get the total. And this is a maximum of $50,000 per qualifying renovation. Technically, you could be renovating more than one suite under this provision, but so it's $50,000 per suite. Then it can be split between other eligible individuals. Remember here, the eligible individual is the person who is claiming the credit. So it's certainly possible to have a situation where more than one relative is paying for the renovations. For example, if I and my wife we are both paying to renovate our basement to accommodate a qualifying individual, then we could split it. An entire family could be splitting it. The total claim per qualifying renovation, though, is $50,000, not $50,000 per person. So you take the maximum amount, you deduct everything what's being claimed by other people, and then what's left over on line 6 is compared to it. So you look whichever is less, the expenses in line 3, or if other people were involved, your share of the expenses only, and those are your qualifying expenditures. After you've done that, the expenditures are multiplied by 15%, and because it's a refundable tax credit, that amount goes to line 45355 of the tax return. All right, so there are differences when you get down into the details between what can be claimed for this credit versus what can be claimed for home accessibility expenses. So if time allows, do have a look at that just to dig into it. But they are going to be different because, of course, the purposes are different. The other credit is specifically aimed at increasing accessibility. This credit is not necessarily aimed at that. It is aimed at creating a secondary living space, period. All right. Okay, let us see how you guys are doing with all of that, and let's give you a poll. There we go. Poll, thank you. Bring up my polling window and give you a question about the home accessibility tax credit. So, all right, we've been talking about a lot, so if you've been paying attention, shouldn't be too tricky. I'm going to set the timer for 1 minute. Okay. All right, so the home accessibility tax credit can be claimed by only senior taxpayers, only disabled taxpayers, senior taxpayers or disabled taxpayers, or all taxpayers. All right, give it a try. Right about 5 seconds left. All right. WebEx is just going to tabulate the results here. All right, and the correct answer, most of you got the correct answer. The correct answer is C. So again, the home accessibility tax credit, it can be claimed by senior taxpayers or disabled taxpayers. It is not restricted to being a medical expense type credit. It can also be claimed by seniors who are not disabled. All right. We've already taken a 15-minute break, so we're not doing 2 short ones. We will just continue. And again, I'm going to go kind of briskly just to make sure we have time for the chapter review problem. All right, so the refundable medical expense supplement we're going to talk about now. Now, this is an interesting one because it's very easy to forget that it's there, but it is there as a refundable credit, which is aimed at low-income working taxpayers who have medical expenses and or disability supports. So if you have an amount on line 21500 and or 32300, you may be eligible for this refundable credit. It's calculated on the federal worksheet and then claimed on line 45200, and there's a maximum claim of $1,464. To claim this, the taxpayer has to be 18 or older and a Canadian resident, and their employment or self-employment income must be $4,275 or more, right? So people with a low income or zero, won't be able to get anything for this. And notice that this threshold is higher than the one for the Canada Workers Benefit. So somebody can be working quite a bit and still not quite qualify for this. Similarly, the credit is reduced by 5% of the net family income in excess of $32,419. So often taxpayers with a spouse or common law partner won't be able to qualify for this one. But if you have a single taxpayer and they have an income, a reasonable amount of employment income that doesn't exceed this threshold, then and they have high medical expenses, then they may be able to claim something. But as you can see already, many people are not going to qualify for this as a result of all these restrictions. All right, so let's look at an example here from the textbook, just to prime our minds and discuss it a little bit. So here's a case of Mary. So Mary is a single parent whose income for the year includes $10,000 in social assistance benefits and $6,000 from a temporary job. Right, during the year, she paid a total of $1,000 for dental work, and her allowable medical expense claim on line 33200 in Step 5, Part B, it's $520. And again, we calculate that as $1,000 minus 3% of the net income. So 3% of $16,000, all right? And again, remember, that's $300 per $10,000, so that would be $450 plus 30, so, $480. So, all right, so we can tell she has high enough medical expenses that they're over 3% of her net income. So let's think about the problem. So will she be able to benefit from the medical expense tax credit, from the non-refundable tax credit for the medical expense? Will she benefit from claiming this dental work as a medical expense? And notice that she's a single parent, so this isn't a case where she might instead transfer it to a spouse. So as we can see, if this refundable credit didn't exist, if she claimed the medical expense claim on line 33200, right, her medical expenses are higher than 3%, but she doesn't owe any tax. So you might think, oh, this person doesn't need to claim the medical expenses. But in fact, by claiming the medical expenses, even though her line 33200, increasing the non-refundable tax credit, isn't going to directly benefit her, it will allow her to claim the refundable medical expense supplement. So for this one, let's have a look at the illustration in the textbook. I think we've got time for that. So illustration, let's move the chat window over here. And we want to look at illustration number 10-18. Right down here. So here we've got the example of Mary that we were just talking about. So again, her taxable income is only $6,000, right? So notice the net income includes $10,000 in social assistance benefits, and those aren't taxable. So her taxable income is really low, $6,000, but it is still higher than the threshold to allow her to claim the refundable medical expense supplement. So the medical expense supplement is then calculated as 25% of the medical expense claim from line 33200. So she claims $130 on line 45200. So you can see this is a refundable credit, so it can be claimed even if the tax has already been reduced to zero. But the key point to note here is that the allowable amount for medical expenses must still be entered, right? So you do have to enter the expenses on line 33200. If you don't put in the medical expenses because you think, it's not going to benefit this person for their taxes, then the refundable medical expense supplement will not generate. Now, the rules and restrictions around it can make it a little confusing to remember, difficult to keep track of who might qualify and who might not. I had one incident one year where there had been a software update and the software suddenly was not detecting that this applied. And I had to deal with an irate customer who was very annoyed that she wasn't getting the refundable medical expense supplement, despite my assurances that surely the software would get this right. So ever since then, I've tried to really be careful handling these situations and just try to be familiar with the rules and when this might apply, because it was no fun to have to go through and manually calculate it and manually override the software. It was not a good time was had. So all right, but luckily that was long ago. All right, but as I say, that's why it's very important for us to know the rules. You can't count on the software to follow everything for you, because occasionally software will get it wrong, and so you have to be able to recognize when a credit should be there, so that when it's not there, you know what to do to try to fix the issue. All right. Now, the important thing, we're nearing the chapter review problem portion. Don't worry, we're getting there. But one thing we want to stress is the rules around the interaction between the disability tax credit amount and claiming various other things. So, if a disabled taxpayer has attendant care expenses, you got to be a little careful. So, if you have attendant care expenses and you're claiming the disability support amount on line 21500, you can claim the disability amount as well. That's fine. And if the attendant care expenses are $10,000 or less on line 33099, then you can still claim the disability amount. However, if you are claiming more than $10,000 in attendant care expenses on line 33099, then the disability amount cannot be claimed. And if you are claiming nursing home expenses other than attendant care, you cannot claim nursing home expenses at all other than attendant care. So things like rent, food, lodging, hairdressing, salon days, things like that. If you're claiming that as a medical expense in any amount, then you cannot claim the disability amount. And the reasoning behind this, I believe, is that the attendant care expenses can potentially be much higher than the disability amount. So you essentially have to make a choice of what would be more beneficial in any given situation. Normally, the optimal choice is to claim $10,000 in attendant care expenses, but no more than that. and this will allow you to still claim the disability amount. Again, unless the attendant care expenses are really high. Okay. Mm, one more thing about nursing home expenses. The nursing home needs to provide a breakdown of the expenses on their receipt to specify how much of their expenses are for attendant care. If no breakdown is provided, then it has to be assumed that none of the nursing home expenses are for attendant care, and none of them can be claimed without disqualifying the person from the disability amount. So this chart is difficult to memorize. So especially your first few years doing taxes. So we more want you to be aware that this rule exists and where you can find this information in a hurry. So you can, of course, find it. You can find it in the textbook easily enough, and it spells it through. And so that can be, and we even have this fine, colorful chart here just to help make everything clear. And we've also summarized it like this. And again, because situations have come up, and as you can see, it goes into more detail here. And the idea is that if you need to, you can refer to this in a different situation. So by all means, feel free to spend some time and have a look at that if you've got more questions. Oh, I've got a frog in my throat. My students know that I've been sick the last week or so, but any of you who've just downloaded this, I am fighting through the final stages of some sort of bug or something. So pardon me if my voice is a little gravelly this evening. All right. Now, one thing we wanted to mention this year, which is a new development, is something called the Canada Disability Benefit. And this is being brought in 2025, has been brought in 2025. So technically, it's not part of the 2024 tax rules. We're bringing this in more for information purposes. And because it's relatively new, some of the information is a little bit tentative, but it was brought in July. The criteria, as far as we can tell at this point, it's necessary to have filed a tax return, and because it's being paid out in July, it's going to be synchronized with the GST HST cycle. So the first payments begin in July based on the tax return, which of course for the year was filed in April. So to receive money in 2025, it's necessary to have filed your tax return for 2024, and you have until the end of April to do that. And so by the end of April, everyone's 2024 tax return is in, and then payments can go out in July. To qualify, you have to be between the ages of 18 and 64 with an approved disability tax credit certificate, and you have to be a Canadian resident. It's necessary to apply for the benefit, and it is administered by Service Canada. Based on what I've seen before and what I understand, this is going to be similar to the GST credit payments. So this money is not going to be considered income. It's more a refundable tax credit, which is intended to support the disabled taxpayer a little bit throughout the year. We will see the full implications of this going forward, but my understanding, based on what we know so far, is that it's similar to the GST payments that people receive. I have heard some odd things that it may affect eligibility for certain social programs. I've heard reports out of Alberta, but I haven't been able to go into them in detail. I've heard reports in Alberta that this $200 a month is being considered as income for purposes of reducing social benefits in Alberta, but I don't know any more details about that. If that is true, and I must stress that I haven't been able to confirm the exact details of that. It seems unnecessarily punitive because I certainly don't think people's GST rebates or tax refunds are considered to be uh, would be factored in when accounting for someone's eligibility for social housing in British Columbia. But who can say? Uh, anyway, for now, we're just bringing it to your attention to be aware of it, and watch this space for developments. Similarly, another new plan. Sorry, Mohammed. Let's pull your question over here. If the taxpayer is getting support from BC Healthcare Assistance, can they apply for CDB um, for the Canada Disability Benefits? Um, I would imagine so. It's applied for through Service Canada, so details would be available on the site. It's kind of external to the tax return itself, just like the GST rebate payments that people get. They're based on your income from the tax return, so it's important to know that they exist, but they're not part of the tax return itself. And similarly here, um, any restrictions like that would surely be listed by Service Canada on the website. I'm unaware of any, but I don't want to speak definitively. And Grant, you're saying relatives lose $200 in Alberta. Okay. Well, obviously, any views expressed here do not reflect those of the H&R Block Corporation. It does seem unfortunate. I think we all can agree on that. All right. Also new is the Canadian Dental Care Plan, which was brought in recently and then expanded. So originally it was aimed at specific groups such as seniors 65 and over, children under 18, adults with a disability tax credit were also eligible. It's now been expanded to include all remaining eligible Canadians. And the eligibility includes you have to not have current dental insurance, you need to be a current resident, and you need to have filed your current tax return, and your family's net income needs to be less than $90,000 for 2024. So if you meet all of those criteria, then you are able to qualify for the Canadian Dental Care Plan. All right. And again, it's based on net income rather than taxable. And again, this is shown more for informational purposes. Okay. Right. So a couple more things, and then we will get to the chapter review problems. So a taxpayer has the disability tax credit on file with the CRA. So let's see how well you remember. Let's say the taxpayer claims $5,000 of attendant care as a medical expense. Can they still claim the disability amount? This is what we call a quick concept check, or in my old job, a CCQ, a concept checking question. Good. So yes, of course, this person is allowed to claim $5,000 of attendant care as a medical expense and still claim the disability amount. Excellent. Now, if they claim $5,000 as a disability sports deduction, can they claim the disability amount? Here, the answer is yes, right? A disability sports deduction claim does not affect the disability amount, regardless of whether it is for attendant care or not. The disability sports deduction, remember, based on the earned income, does not qualify you from the disability amount. Now, if a taxpayer lives in a nursing home and claims $12,000 as a medical expense for nursing home fees, can they claim the disability amount? That's correct, students. Remember, nursing home fees in any amount disqualify you from claiming the disability amount. And even if they're attendant care fees, if they are higher than, if more than $10,000 are claimed as a medical expense, again, you cannot claim the disability amount. All right. However, you can still claim the $12,000 in medical expense. So, in cases like these, you would have to look at what's more beneficial. So if the nursing home expenses, attendant care expenses are really, really high, then this would offset being unable to claim the disability amount. All right. And lastly, I think this one's a fairly easy one. But maybe someone's feeling a bit sleepy. So the disability supports deduction then is set my timer for 1 minute. Is it a non-refundable tax credit? Is it a refundable tax credit? Or is it a deduction? Let's see what you think. About 15 seconds left. All right, and WebEx is just going to take 20 seconds to let you send in the results if you haven't already. All right. Very good. All right, so most of you got the answer correct. The correct answer is C. The disability sports deduction is a deduction. It wasn't a trick question. It's a deduction. All right. Very good, very good. So then, that's the end of the lecture portion. We have got to the end of the content for Chapter 10. And as you can see, Chapter 10, a very detailed chapter with a lot of stuff in it. And a lot of it even so, we've just kind of skimmed over. There's a couple minor topics, so a couple things that we didn't even get a chance to really touch on. The gasoline excise tax rebate and the British Columbia home renovation tax credit. The BC tax credit, at least, we will look at in Chapter 14 if we run out of time tonight. And the gasoline excise tax one is fairly simple. I might slip that in later on tonight, or if we have time allows, or I might slip it in the beginning of next class. We will see. But I want to make sure we have enough time to do chapter review problem 10-1 because I ran out of time in the last class. It's a weekend class, so I will be able to make it up in the next class. But for you guys here, let's have a look at it. Now, let's look at our situation. So this is for Dr. Adam East and Gail East, who are married and live at South End Street in your city. All right, so as we're now typically doing with these later chapter review problems, we're going to give you quite a lot of information, and you have to work through it all to process it all and figure out what to work with and what to go on the tax return and so forth. So for this one, Adam and Gail have lived at the same address for many years outside of the census metropolitan area. Adam works as a veterinarian at the Reptile Ranch, and his T4 slip is reproduced here. He also had $40 for serving on a jury during the year. Sorry, my little tongue-tied, as I said. Adam has a savings account at the Royal Bank, reproduced below, and also received a CRA refund from a 2020 notice of reassessment. So it just got reassessed now, some years later, in mid-June, and the amount of the refund was $887.88, of which $39.93 was interest. Gail also worked at the Reptile Ranch until an accident in 2001, which resulted in a permanent disability. Gail has Form T2201 on file with the CRA. Her income is shown in the information slips below. And they have some medical receipts. All of these are potential medical expenses. You need to look closely at them. And you also need to consider the dates to see what is the most beneficial 12-month period to use to claim things. And in addition, Adam pays $230 per month to the Blue Cross for private healthcare insurance, and this is paid monthly on the 15th. All payments for 2023 have already been claimed on the 2023 tax return. And we can see, is it on the T4? Sometimes it'll be on a T4 down here with a code indicating it. Not in this case, though. Anything else interesting on here? Well, we can see that there's some charitable donations in box 46, some union dues, box 44, and a company pension plan at work. And of course, the income tax taken off in box 22. That's down here, $12,700 for British Columbia. Then we have a T5 for Adam for $115 interest, and T4AP for Gail, showing her CPP disability benefit for $45.50, and a T5 for Gail from CIBC with some interest income. Box 40, Karina, you're asking about? So who remembers, what is box 40? Excellent, Valerie. Exactly. Box 40, basically you can think of this as a taxable benefit. So this is an amount included in box 14 already, which is not money, is how you can think of it. Not wages, certainly. So taxable benefits of some type. Box 40 doesn't specify what exactly they are, so the taxpayer will normally know what they are. But that's the explanation for a box 40. It doesn't affect the tax return. It may sometimes create a difference between the box 14 and the box 24 or 26, although in this case you can see box 14 is well above the maximums for box 24 and 26, so the CPP pensionable earnings and EI insurable earnings are already maxed out in box 24 and 26. All right. And let's see what else. Gail and Adam, both Canadian citizens, want to answer yes to the Elections Canada questions. They equally own a foreign property in the States with a current fair market value of $225,000, and they purchased the property in 2013 for a total of $75,000 Canadian, and the foreign property is used for personal use. So you're going to answer the questions below, complete Schedule 2 and Schedule 5, and if home accessibility expenses can be claimed, you're going to complete the federal worksheet, line 31285. And if there are home expenses which can be claimed, then you would want to also, if applicable, complete the provincial accessibility credit. All right, so, and as you can see, there's a stair lift for Gail for $2,900, including taxes, and we've got some information about it here. All right, so let's dig into the questions. And what time is it? Okay, it's 8:40. Let's see how far we can get. I think we can probably work through most of it. Okay, so let's begin with the questions. So for each of these items, we need to state the amount that Adam has to report and the line number on which he should report it. So 1A, jury duty. Guys, please tell me, where, if anywhere, do we report income from jury duty? Excellent, Diane. Excellent, Yakin. Yes, it is considered other income on line 13000. So the full $40 is reported on line 13000. All right. The Royal Bank interest. What is reported and where? Good. The $115 needs to be reported on line 12100. Good. And what happens to the tax refund, the $887.88? Where is it reported on the return, if anywhere? That's correct. The refund is not reportable, just the interest. So the $39.93 also goes on line 12100. So the Royal Bank interest and the tax refund interest are both combined and reported on line 12100. Good. Now, funny, we were just asking about this. So, guys, how should Adam report the amount shown on box 40 of the tax return of his T4? How is that reported on the tax return? There's no need. It's already in box 14, and this isn't something which the CRA requires to be reported for informational purposes, like, say, commission income or things like that. So box 40 does not have any other effect on the tax return. It doesn't make him eligible for anything else. It's just for informational purposes and really just for the taxpayer. But do bear that in mind. Some of the things that you might see in those information boxes at the bottom, even if they're already included in 14, you may need to enter that information elsewhere on the return for informational purposes as well. Okay. Whoa! I haven't put the question up yet. All right. Okay. All right. No, it's all right. I'm loving the enthusiasm. It's good. But yeah, the people who downloaded this online might get confused. So, yes. So, what amounts, if any, can Adam deduct from the total income? Please list the amounts and line numbers. Valerie, you're correct. 1,800 for RPP contributions on line 20700. The union dues grant, excellent, 448, can be deducted on line 21200. Very good. So the pension adjustment, the 3600 on line 20600, right? So for information purposes, yes. Okay, the CPP enhanced credit, good, that's 838, and that's going to be on line 22215. Excellent. Now, Grant, do you understand why it's 838 and not 650? Remember that, what's the easiest way to do this? Let's look at this T4. Escapey. I think this should illustrate. So remember with the deduction, in a case where there's an amount in box 16A, the second CPP contributions, the entire amount of box 16A is also added to the deduction on line 22215. So line 22215 is going to be 1% of the 65,000, so 650, plus 188, and that will give us 838. And if you work through Schedule 8, you will see that. But, of course, Schedule 8 is a little long and complex But yeah, if you were working through it by hand, you would see that. But the short version is, yeah, this number here is just added directly to line 22215. Right. Well, oh dear, I'm starting to get congested again. But I can make it another 15 minutes. I You all believe in me, so we're going to get there. All right, so I think we've identified most of the things that he can deduct. So again, just to summarize, 1,800 for the RPP contributions, 448 of union dues, and $838 of CPP enhanced contributions. And this means that his net income is going to be how much, students? Or let me go back a step. The total income is going to be 800 and sorry, not 800, 80,000. 83 719.93, and that indeed will give us a net income of 80,633.93. All right, good job. Okay, so now what personal amounts can Adam claim? So the basic personal amount, yes. So personal amounts, we're talking about the non-refundable tax credit, right? Step 5, Part B. So the ones he's going to claim are going to be the basic personal amount, because you always claim basic personal amount, and he's going to claim the spouse or common law partner amount, including the candidate caregiver amount. Right? So the spouse or common law partner amount then on line 30300 will be increased by the candidate caregiver amount. And the disability amount transferred to dependent is not a personal amount. We will get there. Now, who should claim the medical expenses and charitable donations? I think this one's pretty clear. Which of the two taxpayers should claim it? Yes, Adam. Good. They should be claimed by Adam, again, because Gail's income is too low to use them. So even though Adam's income is higher, he should claim them because Gail will get no benefit from them. This isn't a situation where something like the refundable medical expense supplement would apply. Well, that's true, Valerie. There is the option to carry them forward. Charitable donations, certainly you could, although I think in this case they're well over $200, so it's less urgent to carry them forward. But absolutely the option exists there. With the medical expenses, if you push them into the next year, they could only be pushed forward 1 year. There might be situations where that made sense tactically. So, for example, if you were doing multiple tax years for someone at once, then you might look at the situation and consider if it might be appropriate to push them into the next year. As a general rule, though, we don't know what the next year is going to look like at this point, and they can be claimed now, so you may as well claim them now. Because remember, you're always restricted to that 12-month window. You can't just save them up and combine them with next year's in a straightforward way. All right. So for the charitable donations tax credit, what is the amount that can, so the tax credit then, after you put all the donations into Schedule 9 and run the calculations, what is the tax credit they're going to receive? 104.53 is correct. Good. And as we were discussing before, oh, and 53.30 British Columbia. Excellent. So always remember, guys, the BC or any province's charitable donations tax credit is going to be calculated separately using the applicable provincial tax rates. So it's different, but it is there and should be claimed. Um, and it's not going to come up for you guys at this level, but there are sometimes edge cases where the provincial taxes are going to be very different from the federal ones. So there might be some cases where you might want to claim the charitable donations in a given year more for the provincial credit than for the federal one. Um, in general, though, they would probably want to consider uh, holding on to them for another year to increase the amount they can get back. But you'd want to look at the whole overall situation. Okay, I want to at least get through the questions and to the schedule. So, itemizing the medical expenses that should be claimed on the 2024 tax return. So, this also involves the most beneficial 12-month period. So, just in order to save some time, the period, and I'm going to type it in for you, is going to be September 9th, 2023 until September 8th, 24. All right, so Grant, let's see. So you've got the 785 Chinook Laboratories dental X-ray, excellent. The prescription drugs from June 27th, excellent. The August 19th prescription eyeglasses, you'd want to claim that. Good, 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 good. So you got the laboratories, the prescription drugs, the eyeglasses, and you also want to claim the Blue Cross premiums. And so that's going to go. Now here you've got to be. Now remember, the 12-month period only extends to September 8th, 2024. So you're only going to be claiming the Blue Cross premiums for those 8 months. The 2023 ones were already claimed in 2023. So the Blue Cross premiums for 8 months then, 1,840, and the stair lift installation for 2,900 is also going to be claimed because that happened on September 1st. So note that the $185 for the eye exam in October 24, that's going to be carried forward until next year, together with the other 4 months of Blue Cross premiums. So what you should get for line 33200 is a total of $37.95.98. Easy to do, Valerie. Easy to do. So So notice that this 12-month period would have overlapped the previous 12-month period for 2023, which isn't a problem so long as you're not claiming the same expense twice. Okay. Now, so the medical expense claim then, you're $37.95.98, and are they eligible to claim the home accessibility expenses tax credit? Yes, and the matching British Columbia tax credit. Now, who should claim it? Well, the home accessibility expenses is a non-refundable tax credit, so it should be claimed by Adam, and the amount can also be claimed as a medical expense, and is included in the previous figures, and as such, it increases the claim on 33200. Exactly. His employment income is higher than the non-refundable tax credit. Gail won't benefit from it, and it can't be carried forward effectively. All right, so this is what the Schedule 2 looks like. So what can be transferred? It is the disability amount in this case. And remember, Schedule 2, right? The difference between Schedule 2 and Schedule 5. Schedule 2 is for two people. It's for a couple. It's for transfers between spouses. We total together these 5 credits: age amount, Canada caregiver amount for infirm children, pension income amount, disability amount, and tuition amount. Only one applies in this case for Gail. So we take this amount here, the $98.72, and then we look at Gail's taxable income. So it is less than $55,867, and that is less than the basic personal amount and other applicable credits from Gail's return. So this means that the entire disability tax credit can be transferred because Gail didn't need to use any of it to cancel out tax on her return. So it is also transferred. So it is transferred to Adam on Schedule 2. And again, the difference between Schedule 2 and Schedule 5 is for calculating personal amounts. So for the spousal amount then, on the Schedule 5, again, we use Adam's basic personal amount, which could be higher, which could be lower than this if his income was in the 4th or 5th tax bracket, remember. So we add in the $15,705. We add in the Canada caregiver amount here to give the increased spouse or common law partner amount. We then deduct Gail's income, so you don't want to forget that. So it's the net income is deducted here, not taxable, but net. And that leaves the spouse or common law partner amount, which can be claimed in line 30300 as $12,978. All right, and I think that we just have enough time to show you the close the annotation tools here. So we're just going to show you the whole federal worksheet for the home accessibility expenses for affordable stair lifts. So as you can see, the date of the sales slip or contract is entered here. The supplier name, GST number is entered here. Stair lift and installation. You want a description of it here. And this is kind of open form, so it could be stair lift, so it could be stair lift installation. You can write in, note that the space is limited, so something descriptive which is reasonably gets the point across. So the $2,900 here, there's no other expenses, so that's the total expenses. This is less than $20,000, so we just claim the $29,000. This credit is not being split by anybody, and so the $2,900 then is entered on line 31285 of the return for home accessibility expenses. So it is entered here and including medical expenses. Okay, now we don't have time to look for it, to look at it today. We will have a look at it on Wednesday. There is also the British Columbia Home Accessibility Tax Credit, and we will look at that on Wednesday. So if you haven't had a chance to work through the return, have chew it over at home now that you've got this additional information. And on Wednesday, we'll just spend a couple minutes on it. The question you should ask when you get to the end: does it all make sense to you, and do you have any tax tips for the Easts? We will talk about that when we get together next time. But we're coming up on 9 o'clock, so here's what we've covered in this quite large chapter. So to review, you now should be comfortable explaining the rules for claiming the Canada Caregiver amount for various types of dependent. You should understand the application process and the qualification requirements for the disability tax credit and how you can claim that amount and how it can be transferred to a dependent or a spouse, and from a dependent or a spouse to the taxpayer. Sorry, it makes more sense if you say it that way. We've had a look at, and you understand how to calculate the claim for allowable medical expenses. And as I say, next time we'll take a couple minutes just to have a look at the CRA resources, just so you all have had a chance to look at that. And we've also talked about the rules for claiming eligible home accessibility expenses, the qualifications for the disability support deduction, and its interaction with various other amounts. We now know how to calculate and claim the refundable medical expense supplement, and we have an idea of the situations in which it applies. And we've also talked about nursing home fees and attendant care expenses and when they can complicate things. So the conditions for claiming them and how they interact with the disability amount. So for next time, if you haven't had a chance, I do encourage you to take a crack at the entire chapter review problem 10-1, and in particular, if you haven't already, look at the BC Home Accessibility Tax Credit on BC 479. As well, do self-test number 4, and we will be reviewing that at the beginning of next class, and then read chapter 11. And we're going to be doing chapter 11 next time. Do, or at least look at chapter review problem 11-1, which again is going to be another chapter with a lot of content, although slightly more manageable than chapter 10, I would say. But as you will see, the concepts and things that we've been working on in this chapter, many of them are going to have a great deal of relevance in chapter 11, as we will see. All right, but that is all for now, because it is past 9 o'clock and my students are getting a little tired. So all of you who've downloaded this online,